Much higher inflation than anticipated. Boy, the inflation picture, it's hot-blooded. Everyone, mortgage-backed securities having a rough start to the day, down 36 basis points after consumer price index was released. And this was a much higher number than expectations. And we know that bonds hate inflation. And this surprised the markets. Now, putting the July 27th Fed meeting, having almost a 50-50 chance of a full 1% hike instead of the 3/4 that was anticipated, as the Fed assesses now this huge inflation problem that they've got in their hands. The inflation genie clearly out of the bottle. Be careful what you wish for, because remember, central bankers, our Fed, and those around the world, we're trying to get inflation. Well, you got it, and you got more than you can handle here. Let's look at some of these numbers and break them down for you, because they are startling. The headline number, this is for the month. We were getting 1 year readings at 1.3%. Now we're getting it for the month. This is for June. And that replaced 9/10 for last June of 2021, which was a very hot reading. So that pushed the year-over-year number to, get this, 9.1%. It was already blistering hot at 8.6. But here's the thing. We've shown you the chart before. Over the next 3 months, you're going to have comparisons for 2021 that will be replaced very low, 3, 4, 0.5% over the next 3 months. If we get these kind of readings, you could be looking at, believe it or not, a 10% year-over-year inflation. We told you about this. We mentioned it to you. A lot of people thought it wouldn't happen. We told you don't pay attention to people who are saying peak inflation. We believe peak inflation happens in the fourth quarter. Meanwhile, when you take a look at the core rate that takes out food and energy, it was up very hot as well. It is now year-over-year 5.9. That moderated slightly from the 6% level that we were at, but still a really big number. Rents, well, as you could see here, rents up 0.8% for the month, starting to catch up now. These were very low. It's still not completely caught up. Owner's equivalent rent rising. And here's some of the big ones too. First I'll tell you, it's just used cars up 7.1% year over year. Food went up 1% for the month, up 10%. This is where people are feeling a lot of pain, but it's energy. Look at this. These numbers for energy are just through the roof. And I know, Jake, you had some comments on this as well, seeing gasoline go up 60%, energy go up 42%.
Yeah, and I want to give a hat tip to our good friend Peter Bookvar for some great information on the release of fuel from our Strategic Petroleum Reserve. So we're down now from over 700 million to 492 million barrels of oil left in reserve as of July 1st. That's the lowest level since 1986. And by the way, the US population back then was 90 million fewer people than it is today. And as you mentioned, we could see in CPI that energy prices are really rising at a very rapid pace. So this doesn't seem to be helping all that much. And guys, this is supposed to be our safety net. God forbid something happens. So we're going to have to see how this plays out. But at the moment, it doesn't seem like a worthwhile decision to me.
Well, the oil energy companies don't have to. They're not obligated to pass on the additional savings if there are any. And if there were, it's not amounting to much, clearly, as fuel prices are higher. So it helps a little bit, but at what cost? These are, as you said, Jake, insurance policies that we're trading in here. What about when we really do need it? Heaven forbid, as you said, that may be a bit of a scary thought. So remember, eventually, we're supposed to be buying all this oil back. At what price, what cost, what that means, we don't know. Dan?
And we got mortgage application data for last week, and purchases were down 3.6%. On a year-over-year basis, this puts them down about 18%. Now, interest rates, they remained at 5.74%, with a little bit less than 1 point on average. And when we look at the differential from last year, interest rates are somewhere between 2.5% and 2.75% higher today than last year. Now, refinances saw a little bit of an increase, up 2%, but they are still down a whopping 80% year over year. And they now make up about 31% of transactions. Boy, it wasn't too long ago they were making up 0.75% of transactions out there. But this is what I really thought was interesting. You take a look at some of the media headlines from CNBC, from our friend Diana Olick, and the stories that they're trying to spin are extremely interesting. So first of all, they try to make this correlation that demand for big mortgages is shrinking as home prices moderate and expensive houses linger on the market. Well, here's one thing. When you take a look at jumbo loans, they were from 5.28% to 5.25%. So we're talking about 0.03%. These numbers don't stay the same every week. They moderate a little bit. Certainly not seeing a big decline from these big loan prices out there. And they're talking about home prices moderating, but then they go through in the article to say people are taking smaller mortgages because there is a thought that we're seeing slower home price gains, which really doesn't make a lot of sense out there. So also they're saying that houses are lingering on the market. When we take a look at the recent data that we got from the existing home sales, they're on there about 16 days on average. Redfin showing about 2 weeks for most of the homes out there. So not really understanding the media's outlook on this one.
As well as 52% of them bid over asking price. And Dan, when you talk about share, you could have actually jumbo mortgages rise, but if conforming mortgages rise greater than jumbo mortgages, then the share of jumbo mortgages go down. So she's really desperate to try to make some sort of correlation to being wrong for the last 10 years and grasping at straws here. Look, we'll make no bones about it. Housing market is slowing. We know that. But to keep on pumping out and manipulating data the way she does is just wrong. And somebody's got to call her out on it.
And, because of these recent moves we've seen in the bond market, Megan, we are seeing some more inversions on the yield curve.
That is right. We've been talking to you about the yield curve, and taking a look at this chart, we now see that the 1 year is pushed higher and it is inverted compared to the 10-year. Again, we're seeing these recessionary indicators. As far as news the rest of the day, at 1 p.m., there will be a 30-year bond auction. And this is coming after yesterday's weak 10-year note auction.
Thank you, Megan. Let's take a real quick look at the charts here. We see that we're down 36 basis points. Unfortunately, big drop from yesterday. So we did very well with this alert to lock yesterday, as well as the position at yesterday's close to be in locking mode. Now we have broken underneath, clearly beneath the 25-day moving average. Looks like with the damage being done, we could begin the day carefully floating, but let's watch that 30-year bond auction at 1 p.m. Eastern. Hope you guys have a good one.